Hello everyone, welcome to Oliveboard. This is another session of our Sure Shot Topic discussion series for the May 2025 exam. We are discussing the most important topics for our RBWM paper, and today we have investment management for the high net worth individuals. This is Unit 23 from our Module D. Very important. What is the meaning of wealth management? Then, what are the different assets where where the clients, they can seek wealth management services from the banks. We'll be discussing the different mutual fund products, bonds, and insurance products. This is very important from the exam point of view. Definitely, you will see some questions and you can easily score marks here if you understand the concepts clearly. So, let us start with first understanding what is wealth management. Wealth basically means our stored income. Wealth, it combines other financial services to address the needs of the affluent clients, the high net worth individual clients, right? Like investment advice, estate planning, accounting, retirement, tax services. And typically the fees is based on the client's asset under management, that is AUM. So, how can we summarize the wealth management services? We can say that these are the following important aspects of wealth management. Understanding the investment needs. First, we need the clarity of the investment needs. This should be the utmost priority to set the direction. The bank will first understand what are the requirements of the clients. Then, products and services. The wealth manager should have the knowledge about the right products and services. Then, advisory services. The professionals will help the clients take advantage of the professional experience and expertise. And final, estate planning, which is very essential part of the wealth management. It ensures and preserves wealth for a longer term. So, wealth managers can provide services in any aspect of financial field, or they can choose a particular field such as cross-border wealth management. On the basis of the client's needs, their asset under management, they can seek the professional advices. All right. So, now what is the wealth management process or the steps involved in the wealth management process? We can say that it involves assessing the current financial situation of the client, understanding their financial goals, then designing a tailor made customized solution to achieve the goal, then implementing those strategies and monitoring the results and reviewing the plans. Making changes is also important. So, continuous process involved in helping the client reach their financial goals, that is wealth management. And wealth management provides direct dynamic customer services which deals in asset allocation management, tactical management, and diversified management. Asset allocation management, where it is fully directed to managing the investment portfolio. The only focus is on initiating the income generation. All right. Tactical management, however, helps in selecting the appropriate ways to achieve the financial strategies. And diversified management, a flexible model which helps meeting the need of the client. So these three processes or steps in wealth management is important. All right. Now we will start with discussing the important wealth management products and services. So we have many wealth management or wealth products such as alternative assets are there, bond, corporate fixed deposits, insurance products, mutual fund products, SIP, portfolio management, real estate. These are all the products and services where the individuals, they park their wealth. They want to invest large amount of money, then they can go for wealth management. Let us start. First, we have the alternative assets, which are substitutes to the traditional products. These are the non-traditional asset with potential economic value, like unique art and antiques. precious metals, fine wines, rare stamps, coins, sports cards, and other collectibles. People who have a hobby, they also invest their money in these types of assets. So these are alternative assets, and because of their unconventional nature, valuation of some of these assets can be very difficult. So here, the professional managers, they step in using their expertise and knowledge. They help in the assessment. Next, we have the bonds, which is another asset or product where we can invest our wealth. Some important points about bond. They are fixed income instruments derived from a loan forwarded by an investor to a borrower. Fixed income instrument. We get some fixed income. So the issuer who is issuing the bond will promise to pay a specific interest for the life of the bond and the principal amount or the face value at maturity. So if I am investing rupees 50,000 in a bond, then and this bond is, let's say, for 10 years, then regularly for 10 years I'll earn some interest on it, and after 10 years I will get my face value back. That is, on maturity I will get the principal amount back, right? So it is a type of loan which is forwarded by an investor to a borrower. Bonds can be issued by governments, corporations, municipalities, and other sovereign bodies, and these are tradable in the market, right? Another advantage of trading debt securities like government bonds is that it is also, there are also tax free bonds, there are also corporate bonds. So depending upon the risk taking of the investor, of the client, we can diversify our investment, and this is known as the bond market. So there are different types of bonds: bonds which are issued by the government, treasury bonds, corporate bonds, convertible bonds, zero coupon bonds, inflation linked, high yield. We'll see some of these in detail. So first we have the convertible and the non-convertible bonds. Bonds which offer or they give certain option to convert it into shares of the company. So they allow conversion, that is a convertible bond. Now there can be a right or an obligation. Right means here the bond holder will have the right. They can or they cannot. If they want, then they can convert the bond into shares, otherwise they will not. Obligation means that they have to convert it. So we have the right or an obligation to convert the bond into shares. So the investor can convert the bond into stock only at the certain specified times, and these times are fixed. So what are the features of convertible bond? They feature a fixed tenure, pays out interest payment periodically at predetermined intervals. So there are three types of convertible bonds. Regular convertible bonds. Here only the right is given to the investor, not an obligation. That is, there's a fixed maturity date and a predetermined conversion price. At the maturity, if the investor wants, they can get the bond converted into a share. Otherwise, they can take the value back. Mandatory convertible bonds, which gives an obligation. Now the investor has to convert it into equity shares. They don't get an option, they get an obligation. Mandatorily, they have to convert the bond into equity shares. And reverse convertible bond, here in regular and mandatory, the right or the obligation is on the investor. But in the reverse convertible bond, the issuing company holds the right. They can convert the bond into equity shares upon maturity at a predetermined conversion price. So regular and mandatory, right and obligation to the investor, and reverse convertible, right given to the issuing company, company which issues the bond. This is one time. Non-convertible, obviously, which cannot be converted into shares. Then we have government bonds, which are rather stable. They're backed with government insurance that you will get a fixed payment, right? So bonds are issued by the central as well as the state government. in order to tide its liquidity crisis. When the government wants to raise funds, they can issue bonds and they will get money in return. If let's say they want to control, then it will go in the hands of RBI in the open market operations. That is a separate topic. But when the government wants to raise funds, they can issue bonds in the market. So they serve as the long term investment tools which can be issued for a period from 5 to 40 years. Stable returns and extremely free because they are guaranteed by the Indian government. The interest rate on government securities varies between 7 to 10%. Each of these highlighted points are very important, so make sure that you understand them. Then we have certain types of government bonds. Fixed rate bonds, there's a lock in period. Only after that you can get your payments or you can get the maturity value. So there are lock in period for such bonds, which is usually 1 to 5 years. For example, 6.5% Government of India 2024 fixed rate bond implies a rate of interest applicable on the face value amounting to 6.5%. Premature withdrawal can lead to penalties, right? Higher the bond term, more it runs the risk of reducing bond value because there is year on year rise of inflation. So the value of the money will go down. So it gives a fixed value. The rate of interest will remain fixed throughout the term of the bond. Then floating rate, floating. Now the rate of interest changes. These bonds have the variable interest rates based on periodic changes. They will help mitigate the interest rate risk. There's an interest rate risk in the fixed rate bonds because even if inflation is there or any other reason, the value is going down, still you will get a fixed rate. But in the floating rate, you can get a higher interest rate, right? So it is when's the best time to buy such a bond? It is when the rates are low and are expected to increase. All right. Then we have the sovereign gold bonds. What are sovereign gold bonds? Where we can invest in the gold. These sovereign gold bonds offer interest which is tax free. Nominal value can be arrived by calculating the average, simple average of the closing price, 99%. So it offers purity level, a good purity level. Liquidity of the sovereign gold bonds is possible following a period of 5 years. Very recently, an amendment has been made in the sovereign gold bonds. All right, so this is also important. Then we have the inflation indexed bonds where the principal and the interest earned is in accordance with the inflation. So when the inflation rises, accordingly, or the inflation falls, accordingly, the interest rate will also change. Then we have the 7.75% Government of India saving bonds. The interest rate which is applicable is 7.75%. Who can invest in these types of bonds? Individuals who are not NRIs, they should be resident Indians, minors, Hindu undivided family. Interest is taxable and minimum amount is 1000 and further in the multiples of 1000 rupees. So these are the Government of India savings bond. Then we have the bond with call or put option, that is the buy and sell option. Call option where the issuers are entitled to buy back the bond. The company that is issuing or government, let's say, that is issuing the bonds, they have the right to buy back, right? And put option, now the right to sell is with the issuer. So the issuers are entitled to buy back such bonds via call option, and the right to sell the bond is known as the put option. So we will remember it like this: call, calling back, so buy, and put, selling of the bond. Right to sell the same with the put option. Then we have the zero coupon interest, which pays only the principal on maturity. These don't earn interest. Investors can accrue returns via the difference that exists between the issuance price and the redemption value. So if the redemption value is more than the issuance price, then there will be a profit. All right. They aren't issued via auction but created via the existing securities. So these are the zero coupon bonds. Coupon means interest. You don't earn any interest here. You get the profit. That is the difference between the issuance price and the redemption value. These are the various government bonds. Then even municipal bodies, they issue bonds. Like, what are the municipal bonds in India? There are the general obligation. These bonds basically are raised or issued for raising money for various public projects. All right. So these are issued on behalf of the municipal corporations, and they can be purchased with a maturity period. So general obligation bonds, they do not define a particular project. The bonds can generate finance for various projects in general, and therefore the repayments are from the general revenue. So more than one projects can be financed through the general obligation bonds. Revenue bonds for specified projects, specifically for, let's say, roads or highways, anything, specified projects. Maturity value up to 30 years. Retail bonds are additional when we have already issued a bond and now we need additional capital. So to raise additional capital by borrowing at a fixed rate from the investor. And they are typically listed so they can be bought and sold during the regular market hours. So this gives the investors more flexibility. All right. So why are retail bond issued? To raise additional capital. Why are revenue bond issues? For funding specified projects. And why are the general obligation? For some general projects. Then we come to the next product for investment, that is insurance. What is insurance? It is a promise where the insurance company promises the insurance buyer or the holder to make good any loss, to make, to pay for the losses. All right. So the insurer or the insurer's carrier is a company selling the insurance, and the insured or the policy holder is the person who is buying the insurance policy. The amount of money to be charged is called the premium, and the insured receives a contract. In this contract, the conditions and circumstances in which the insured will be financially compensated are given. So, if I'm buying a health insurance, so the health insurance will cover the various medical expenses, hospital bills, as per the terms and conditions in the contract. So, that is insurance. Life insurance will protect my family in unforeseen situations like death. Term insurance, it provides financial safety. Disability insurance is there, auto insurance facility, home insurance will protect one's house, travel insurance is also there. So there are many types of insurance products. Each will cover one type of emergency. So the insurance company will pay us if that situation actually occurs. All right. Then we have the next product, which is mutual fund. Mutual. Here, the individual is not investing on a single basis. Rather, the funds are collected from different interested investors and they are pooled in and then invested in the securities. So, the mutual fund provider will define what is the goal of the mutual fund, in which type of securities they are going to invest the pool of money, in stocks, in bonds, money market, or any other asset, right? The mutual funds are handled by the fund managers, which are also known as the portfolio managers. Depending upon the goal, the basket of shares, bonds, money market, or mutual funds can also be for investing particularly in a sector like bank, IT, infrastructure, or even a basket of diversified shares. So the mutual fund provider will specify where they are going to invest. Accordingly, according to my own needs, I will subscribe and invest my money there. So, based on the investment objectives, how can we define the or how can we categorize the mutual funds? We have the equity mutual funds. As the name suggests, money will be invested in the stock market. right? Purely based on the stock performance of the fund. Then we have the debt mutual fund in debt instruments like treasury bills, government bonds, and they will ensure us a fixed rate of return. So, for safe individuals who want regular returns, not very high, they can go for debt mutual funds. Balanced, a mix, partially into equities and partially into debt, right? Then we have the sectorial funds. In particular sector, we are going to invest our money like IT, banks, FMGC, pharma. So we are investing the stock, we are selecting the stock based on the selected sector's preference. And the returns will obviously depend on the stock performance belonging to the specific sector. Then we also have the equity linked saving schemes, which is the tax saving funds. So whenever I'm investing money in the ELSS, I can claim it because it is exempted from income tax under Section C. Another important feature of ELSS is that it has a 3 years of lock-in period. All right. Then these are based on the investment objectives. We also have on the basis of structure the open-ended and closed-ended fund. Open-ended are more flexible, which allow you to invest money and redeem anytime as per your needs and strategies. Closed-ended funds, however, they come with a fixed period. They here we have to invest with some lock-in period, mostly between 1 to 3 years. So one cannot redeem before the lock-in period because it is a time-bound investment, right? So for some fixed period, the closed-ended fund exists. And then finally, we have the SIP and the SWP, systematic investment plan, where if I do not have a good amount of fund at once to invest, what can I do? I can invest in intervals, right? So it allows individual to invest a fixed amount at a regular frequency, so every month, right? So fixed sum of money at selected scheme of mutual fund, predetermined intervals like monthly, quarterly, etc. So it is a systematically planned investment, and that is how we invest in intervals. Systematic withdrawal, on the other hand, it allows the investor to withdraw at amount at predetermined intervals. We can also choose the amount as well as the frequency, right? So what happens in the SWP? Units from the portfolio are sold and then the funds are transferred to your account. And when I say that the pool is invested, so depending upon how much I am contributing to my pool, this is known as units. Units that I own in a mutual fund. Accordingly, when the dividends generate or whatever income is generated, it is distributed, right? So the units that I hold will determine my income. Other than this, we also have the real estate services, retirement planning, will writing, and so on. So we can say that what are the benefits of wealth management? It gives us a customized financial plan upon depending on my own requirements and financial goals. Financial stress is eliminated because now with the professional expertise of the wealth managers, I can have a deep understanding and I also get personalized services, right? So there's a flexible investment approach. These are the benefits and the importance of wealth management, and that is all for today. Again, I will repeat, this is a very, very important topic, so make sure that you understand each and every concept very clearly. When you're revising, go through the notes. All the highlighted points are important. Definitely, questions will be framed. This is one of the most important chapters of our whole syllabus. So if you liked the video, make sure that you hit the like button, share it, and subscribe to the channel because now your exams are very near. Each of these videos and other sessions are very important. So that you do not skip or miss any videos, any sessions, you need to subscribe. So subscribe to the channel and comment down below if you want me to cover any other topic, any other session, anything. I will see you again with other such important sessions. Till then, thank you and all the best.